Green investing, also known as sustainable or socially responsible investing, has gained momentum as individuals and institutions look for ways to align their financial goals with environmental values. It involves directing capital into projects and companies that support ecological sustainability, reduce carbon footprints, and promote clean energy, conservation, and social responsibility. As climate change and environmental degradation become more pressing, green investing is no longer a niche interest. It's becoming a core part of smart, future-focused financial planning. Today, we will talk about green investing, how to invest sustainably and profitably. So before we start, make sure to hit the like button and subscribe to my channel. What counts as green investing? Green investing focuses specifically on environmental impact, although it's often part of the broader umbrella of ESG, environmental, social, and governance investing. Examples include investing in renewable energy, like wind and solar power, energy-efficient technologies, sustainable agriculture, clean water, and companies that have strong environmental policies. It's not investing in businesses or funds that actively work to improve environmental outcomes or reduce harm to the planet. The rise of ESG funds and ETFs. One of the easiest ways for individual investors to begin their green investing journey is through ESG-rated mutual funds or ETFs, exchange-traded funds. These investment vehicles screen for companies with strong environmental credentials, while avoiding those involved in fossil fuels, pollution, or unethical practices. ESG ratings are provided by agencies like MSCI and Sustainalytics, which evaluate companies based on factors like emissions control, waste management, water usage, and green innovation. Direct investment in sustainable companies. For more active investors, directly buying shares in environmentally responsible companies is another approach. These might include firms like Tesla, electric vehicles, Nexter Energy, Renewables, or Ormat Technologies, geothermal energy. While potentially rewarding, this strategy requires more research to evaluate each company's true commitment to sustainability and their financial strength. Investors should be cautious of greenwashing, where a company exaggerates its eco-friendliness. Green bonds, investing in environmental projects. Green bonds are debt instruments specifically issued to fund environmentally friendly projects like solar farms, wind turbines, clean transportation, or pollution reduction. They are typically issued by governments, corporations, or international institutions. Investors earn fixed interest while supporting measurable environmental outcomes. A subcategory, climate bonds, focuses directly on combating climate change, making green bonds a powerful tool for impact investing. Understanding impact investing. Impact investing is closely related to green investing, but puts measurable social and environmental impact at the forefront, sometimes even above profit. For example, funding a company that develops clean water systems in underserved regions or investing in sustainable agriculture ventures. Many impact investors track their portfolio's progress using environmental KPIs, key performance indicators, ensuring they can see tangible ecological benefits alongside financial returns. Green real estate investments. The real estate sector is a major contributor to energy use and carbon emissions, but also a strong area for sustainable investment. Green REITs, real estate investment trusts, or certified eco-buildings can provide stable income and long-term growth. Properties with LEED, Leadership in Energy and Environmental Design, or BREEAM certifications are more energy efficient and often yield higher rental value and resale potential. Corporate shifts and sustainability reporting. As investor demand for green options rises, more companies are publishing sustainability reports and setting emissions reduction targets. Many align with global frameworks like the UN Sustainable Development Goals, SDGs, or the Task Force on Climate-Related Financial Disclosures, TCFD. This trend is helping green investors find more transparent and credible companies to include in their portfolios. Challenges in green investing. Despite its growth, green investing comes with challenges, particularly the inconsistency in ESG ratings across different agencies. A company might receive high marks from one and poor scores from another due to differing methodologies. Additionally, green investing requires diligence to avoid misleading marketing. While some argue that prioritizing sustainability can lower returns, evidence increasingly shows that ESG portfolios often perform as well or better than traditional ones over time. Balancing profitability with sustainability. Investors must strike a balance between ethics and earnings. While it's tempting to support a company with a strong environmental mission, it must also have a viable business model, solid leadership, and competitive advantage. The most successful green investments are those where sustainable practices also lead to innovation, cost savings, and long-term financial growth. Getting started with green investing. Beginners should start by identifying their values, whether that's clean energy, conservation, water management, or reducing plastic waste. From there, investors can find green mutual funds, ETFs, or robo-advisors that support those priorities. It's also important to periodically review and rebalance portfolios to stay aligned with both financial goals and environmental values. The future of green finance. As regulations improve and awareness spreads, green investing is likely to become the norm rather than the exception. With growing government support for clean energy and sustainability, sectors like renewable infrastructure, electric transport, and eco-friendly technology are expected to drive economic growth. Investors who act early may not only contribute to a healthier planet, but also capitalize on strong financial returns. Role of government policy in green investing. Government policies and international agreements play a crucial role in shaping the future of green investing. Incentives such as tax credits, grants, and subsidies for renewable energy projects help reduce the risk for investors and make green technologies more competitive. Major global agreements like the Paris Climate Accord have prompted nations to commit to carbon neutrality goals, which in turn encourages investment in clean energy and sustainable infrastructure. Additionally, regulations mandating ESG disclosures by public companies are increasing transparency, helping investors make informed decisions. In countries where governments are proactive about green finance, the ecosystem for sustainable investing becomes more robust and attractive. Green investing in emerging markets. While most green investments are concentrated in developed economies, emerging markets are increasingly becoming important players in the sustainable investing landscape. Many developing countries are rich in natural resources like solar, wind, and hydropower potential. Green investing in these regions not only fosters sustainable economic development, but also addresses critical issues like energy access, water scarcity, and pollution control. Investors willing to take on slightly higher risks can find substantial growth opportunities in projects like off-grid solar in Africa or sustainable farming initiatives in Southeast Asia. Tech innovation as a driver of green returns. Technology is a major catalyst for both sustainability and profitability in the green investing space. Innovations in energy storage, smart grids, carbon capture, and AI-driven efficiency systems are transforming how we manage and reduce environmental impact. Startups and public companies alike are creating products that not only lower emissions, but also disrupt traditional industries, opening up entirely new markets. For example, green hydrogen technology and electrification of heavy industry are emerging fields that are attracting serious investment. Venture capital in climate tech has skyrocketed, reflecting strong investor confidence that tech-enabled green solutions will drive both climate progress and substantial returns over the next decade. Building a long-term green investment strategy. To succeed in green investing, it's essential to adopt a long-term mindset. Sustainability-oriented businesses often take time to mature and show consistent returns, especially when compared to high-growth but environmentally harmful companies. Investors should think in terms of 5, 10, or even 20-year horizons, understanding that the green economy is still evolving. Regular portfolio reviews, risk assessment, and staying updated with regulatory trends will help fine-tune the strategy over time. Diversifying across sectors like clean energy, sustainable agriculture, water tech, and green real estate can also help manage risk while capturing growth across the broader green economy. Patience, research, and commitment to values are key to building wealth through sustainability. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.